Ever pondered over the intricate process of recording financial transactions in a business? It's quite an intriguing subject, especially when you delve into the double entry system. This system, fundamental to accounting, has been the bedrock of financial record keeping since its inception in the 15th century. In essence, the double entry system is a method of recording financial transactions where every transaction affects at least two accounts. One account gets a debit entry, while the other gets a credit entry. These entries are equal and opposite, keeping the accounting equation in balance. So, how does the process work? Imagine a game of chess where every move is calculated and has a specific purpose. The first stage is the source documents. These are the evidence of a transaction, such as an invoice or a receipt. The next stage is recording the transaction in a journal. This is where the chess pieces start to move. Every financial transaction is recorded chronologically, detailing the accounts affected, whether they are debited or credited, and the amount of the transaction. Then comes the ledger stage. In this phase, the transactions recorded in the journal are transferred to individual accounts to show the total balance. It's like understanding the position of each chess piece on the board. Finally, the trial balance is prepared. It's a summary of all the debit and credit balances of the ledger accounts to verify the arithmetic accuracy of books of accounts. But like all systems, the double entry system has its drawbacks. It can be complex and time-consuming, requiring a deep understanding of accounting principles. It can also result in errors if not properly managed. Now, let's shift focus to another fundamental concept in accounting: assets minus liabilities. Simply put, it's the net worth of a business. It's the residual interest in the assets of the entity after deducting liabilities. Ever heard about GAAP? The Generally Accepted Accounting Principles, or GAAP, are a set of rules and standards that guide how financial statements are recorded and reported. It's like the rule book for our chess game. What about liability accounts? These are ledger accounts that record a company's debts, obligations, or future costs. Examples include accounts payable, loans, and mortgages. There's often confusion between accounts receivable and deferred revenue. Accounts receivable is money owed to a company by its customers, while deferred revenue is money received by a company for goods or services not yet delivered. The question of where to record a cash discount in a journal entry often arises. It's recorded as a debit to the sales discounts account and a credit to the accounts receivable account. And a compound journal entry? It's an entry that affects more than two accounts. It's like a chess move that puts the opponent in check and protects your own piece at the same time. In a nutshell, the double entry system is a complex but efficient method of recording transactions, keeping the books balanced. It's a fascinating world of debits, credits, assets, liabilities, and so much more. So, the next time you look at a financial statement, remember the intricate chess game that goes into creating it.